Today, I am pleased to have with me Fiona Laidlaw. She is an M&A advisor in the APAC region for Flipper.com. And this Flipper is the world's largest marketplace for buying and selling online businesses. So you may be a startup founder, right? You may be in the early stage, the later stage, knowing where and when you want to look at a potential exit. It's so important to know that you have that lever there. So a bit more about Fiona, and then I'm going to pass it over to her. So she's had over 6 years working in account management and online brokerage in this space, working with businesses all the way selling from $250,000 through to $50 million. So, quite a diverse range. She's a certified merger and acquisitions advisor. And she helps both the buy side and sell side clients. So I've invited here today to really, we were talking a lot about this, Fiona, right? That a lot of startups just jump in, they're just building. And they often find out about this when it's too late or they're in the corner. So hopefully this can help a lot of people earlier than that and to be a bit ahead of the game. So without further ado, if I pass it over to you, Fiona.
Yeah, thank you so much. We've talked about knowing how to exit before you need to is really important in getting the most out of your exit. So that's really what I want to get out of today is help your community understand, how to prepare for that exit. So appreciate the time and inviting me on here, and I'm excited to learn some more. So like you said, Flipper, #1 platform for buying and selling online businesses. So I've been with Flipper 3 years, and who are we? This is kind of what we're talking about today, but who is Flipper? Why, what to consider when you're exiting, the actual broker process outlined, what you need in order to exit, of course, valuations, which is what everyone wants to talk about. It's the exciting part, it's the meat of it. Who are the buyers? And then we'll look at some case studies to help as well. So who is Flipper? So as you mentioned, we are the largest marketplace to buy and sell online businesses. So we have over 400,000 weekly active buyers. We really specialize in connecting technology with our buyer matching tools, benchmarking, comparison, our integrations with our people. So that's our business broker team. So we marry the technology and the global reach with real people like myself who are helping you sell your business, because it is a very emotional, it is very it's quite an intensive process. So to have that team helping you as well
I'd
as
say
the technology,
it's almost like people are selling that baby, as the saying goes. So they build it from scratch, so there's a lot to go through. Okay, very good.
100%. Yeah, so that's me, not too much time on me, but basically what I do as a business broker is I help you exit. So I match you with, well, first off, I understand your business, I understand what it is that you need, I understand why you're exiting, and then I match you with the buyers, and then essentially help you through every step of the process, whether it's from initially marketing out the business and qualifying those buyers to negotiating, due diligence, and close. So you've got someone working with you the whole way. Awesome. So I think a big question is, why are we even talking about an exit when maybe I'm just starting a business, or I'm not even thinking about an exit? But it is really important to think about an exit, because right from the start, and how to prepare for that, because the best time to exit is before you have to sell. So if you're going through a big life change that maybe you have to sell your business, someone's unwell in your family and you have to take care of them. I've had situations like that, and they've had to sell their business. You're not going to be as prepared, and you're not going to get the valuation that you want where you sold, if when it is essentially the best time. A huge one that we see all the time is burnout. So entrepreneurs and founders get to 5 to 8 years, it's not an easy thing to run your business, and to establish a successful business and continue to run it every day, because we know it's not a 9 to 5, it's a 24/7 thing. So people start to lose their passion, and then the business starts to suffer. Or maybe they're a bit more of a creative and they love inventing and establishing businesses, but they don't like that CEO hat. So their business gets to a point where it needs that CEO hat, but they have decided, I've already got a new idea, I've already got another venture I want to do, and so the business suffers, and you essentially will get a lesser valuation. It'll be harder to sell. You've just lost that. You kind of just say to me, Fiona, just get rid of it, versus, hey, let's find a really good buyer for this. So
let's go for the optimal thing.
Yeah. And then,
if I can just come in there, Fiona, I think that the stock standard for founders that we find is that people are coming in going, I want to build that next unicorn, and you know what I mean, no amount of money is going to stand in my way. But then, as you said, after you're getting to 5, 8 years, 10 years, I mean, it can be a very different situation. And so, number one, statistically, the vast majority of companies are going to go through an acquisition as an exit, compared to going to these billion-dollar valuations. And what I would say, on one hand, we don't like to clip anyone's wings, right? We want people to have that ambition, that drive. But on this other hand, it's really being realistic with, these are real options that I have, and sort of getting to that next horizon, so that you're not, as you said, coming there with burnout and then just going through a suboptimal sale, which we've seen a lot of. If they just prepared a few things, they could have gotten 2x, 3x for what they've built over so long. I think it's so important.
Absolutely. And there's no, you don't have to do it on your own. You can build a really big company. You can build $1 million company and then sell it to someone who's going to make it a 10x that, or a 20x that, and that's still something you've built. You've still been without you, it never happened. So I don't, people don't have to do it on their own. And I think that kind of goes into that third point of when your business is positioned to scale. So the buyers that come to us and say, hey, Fiona, this is my criteria, this is what I'm looking for, it's because they don't want to start a business and do that 0 to 1, or they don't know how to, and they're better off in that CEO hat, and that they've got the skills to scale it. So you're finding a match that's going to help your business grow. So that's when you're going to get the best valuations. So the broker process. So, I mean, why do you need a broker? Could you just sell this on your own? I think we've kind of touched on a major one before, is that it's emotional. It's emotional when money gets involved, when it's your money, or it's your baby, as you put it. So having a professional, experienced M&A personnel, they're going to be able to bring that reasoning, that experience, yes, but also just that non-emotional third party that says, you know what, this is a good deal, or hey, no, you've got the rose-colored glasses, there's a lot of risk here. So our process is that we do qualify and manage the buyers. So we're able to, give you the background on them. We're able to provide you with our experience working with them, that sort of thing. We help the deal move forward, and we oversee the due diligence. So, that is necessary to give them that information, or no, we don't want to be revealing any customer data, any code, anything like that. That's not required. So just helping guide you with what is a very consuming and quite a long process, helping guide you on what you actually do need to do and what you actually don't. And then, of course, at Flipper, we do have that huge network of global buyers. So I work with, I close a deal out of Thailand with an Indian buyer, close a deal in New Zealand with a US buyer. So just being able to have that reach to buyers that you wouldn't expect you'd be talking to otherwise.
Yeah. And I think that the one thing here is that there's a context going on that people are still managing their businesses as they're going through this process. And a lot of the times, I've seen that people, I mean, it's going to take something regardless, but if you don't have an expert team, you're going to then be putting, let's say, double the time, and then it actually impacts your numbers, it impacts your customers and so on. So yeah, I mean, these are the broader things to take into consideration.
Yeah, absolutely. Couldn't have said it better. So I've just got a little, snapshot here of just the sell side process. Everything, it starts off with the evaluation, and then marketing and onboarding and getting your data room ready, or your initial data room ready, and then we go out and find your buyer. So that it says up to 12 weeks. That can really vary. It varies on size of the business, valuation, current state of the business, type of business and market. So a number of, several different things that would change that. And then, we go into negotiating a deal. What are the terms of the deal? What's the pricing? How long is the owner going to stay on if they are? All that sort of stuff, and then final due diligence. So I use the analogy of when you go shopping for a car, you kind of look at the car and you say, that's nice, it looks nice, it's got good interior. The final due diligence is you pulling up the hood of that car and looking at every nut and bolt and making sure that the engine runs properly. So that's exactly what the buyers are doing. They've kind of seen the outside of the car and the inside of the car and said it's nice. The final due diligence is they're pulling it apart. So that is, fairly full-on consuming process up from step 1 to 5, and then we finally get to the transaction and finalization, which is signing of documents and transfer of the business and the funds.
Got it. So in step 4, is it that they put down some deposit or something to mark their interest? Is that right?
Yeah, so that one's definitely an LOI, so letter of intent. So that's it's a non-binding document, so legally it can't be accountable, but it is a document that says I'm going to put my intent based on the information I've got is to buy this business based at this price range, this deal structure, and then further due diligence. If there's nothing that comes up in that final due diligence, the deal will most likely stay the same. If something does come up, additional risk, something doesn't align, something can't be verified, then there will be a renegotiation. So that's why, I not often, but I've had sellers come to me, and say, oh, we just won't tell them that, or, we just won't share that. And it's you're just shooting yourself
come
in the
out in the wash
foot
at some point.
Yeah. You want to get the step 4 and as close to true as possible. Obviously sometimes things come up, it just happens, but that'll save it in the end.
Absolutely. And I see, about 800 startups we've worked with now, and we keep seeing this pattern, because a lot of this is whether you're selling shares in your business as an investment or you're going through the full acquisition. Obviously, there's a lot of overlap here. How much do you find, especially because I would say certain things happen in stage 4 where, we're going to speak about the valuations in a moment. How much do you find that really the team knowing how the process is going to go, that aids the process? Because as you said, someone can technically sell it themselves, but what I find is that a lot of people go in, they don't know the steps, and then it can look really clunky to the buyer, and it even can then shock the deal and stuff the deal?
Yeah, so I think it's tricky, right? Because the size of these businesses, and we're not saying that you need to have everything perfect, no business does, but having an organized, having organized financials, knowing your business really well is really important in getting that step 4 like as true to a deal that's going to go through as possible. So if you're trying to do this on your own and you're not essentially kind of, even from that initial valuation, I'm sitting there with you and we're discussing the business and I'm giving you feedback on why it's good for the market or why it's not, or why buyers would like to see it or why not they're not. So you're already getting information that's going to help you get closer to that valuation and that deal at the end. So we might have a conversation at the start and your valuation expectations might be, say, 3x, and I'm giving you feedback that that's not what's happening in the market. And I'm kind of talking you through that throughout the whole process so that when you get to step 4, you can kind of understand why you're getting offers at 2.5 instead of a 3.
Yeah, that's right. And we were talking a little bit about this. What I'm finding interesting is that, and we have a few sections that we're going to go into deeper for everyone listening to this, in some of those factors, right? What can get in the way, what can lift the valuation higher, lower. But a lot of that actually happens, I would say, pre this step 1 and step 2.
100%.
Right. So like how you set up your technology, we're going to talk about that, how much you're systemizing your business. So yeah, I think for everyone listening in, it's like seeing this as a full end-to-end process that as you're building your company, if you have these things in mind, then you already are setting yourself up with more options, if you want to go down this path.
Yeah, and I think just like we keep saying, like knowing maybe you're not going to sell for 2 years, 4 years, whatever it is, but knowing that this is a process, that this could take 6 months, then knowing that is helpful to get the best valuation for your business.
Awesome.
So this is really just a little slide kind of just going through what Flipper does, all in one platform. I've kind of mentioned that we marry, technology with our broker team. So that's the people here. And then we have, buyer matching tools and integrated escrows, benchmarks and comparisons from 15 years worth of data, dynamic multi-user deal room where you can invite your lawyers in, your accountants, just all that sort of stuff to make it the most efficient process as possible. So I guess going into, why do I need to exit? Or what do I need to exit? Sorry. So this we just touched on before is what is it that's going to be the documents, the organization of the business that you need to exit. There's going to be a ton more than this, but here's just some, I guess, metrics to get your head around. And if you came to me, this is what I'd be asking for first. So you need to know your business on a month-to-month breakdown of your P&L. It says trailing 12-month there. I prefer 36 months, so 3 years. But because that will show year-over-year growth, it shows seasonality. We can pinpoint and say, why was November so big? What happened there? And it's, Black Friday or something like that. So we can kind of get a really good understanding of what the patterns of your business are on a revenue stream. And then your balance sheet, what debts you have, what liabilities, what assets, and of course we have to prove all this. So we can't just say I'm a $3 million revenue generating business. You have to back that up with your dashboards, your accounting software, your tax returns, things like that. So they're the financials that they're just the start. If you have suppliers, if you have large clients, anything like that, contracts are really important to have, and you may not have them in your business. This is something that your business can be sold without, but it puts a risk on the buyer. So if I'm coming in and I'm a buyer and you rely very heavily on one supplier, if you do not have a contract with them, to me, that's a high risk because they could just walk away at any point. So if you're thinking about exiting, if, whether, like I said, 6 months, 2 years down the track, I would get a supplier contract in just as a best practice. And then metrics, know your churn rate, your lifetime value, number of active subscribers, average order value. Obviously, these differ depending on your business model, but they're just some very simple metrics of just knowing where your business is and what condition, I guess, where it's currently at, what condition it's in.
Yeah. Well, what I'm seeing here is, I mean, when we work with people for investment readiness, for example, then it's all about putting yourself in the mind of the investor, and then going through the thing. And I think this is completely the same. In the end of the day, these are the bare bones to give the accurate picture where your business is at, what's going on, are things trending down or up, and then backing that up with the data, right? Like, you can't just say, as you said, 3 million, and then on paper there's only 1 million there. So you just have to have the things that people can rely on.
Yeah, it has to be tidy. And like I keep saying, no business is perfect. So there's nothing wrong with maybe marketing is not your strength, and that's your gap. A gap is good in the business because it allows an investor or a buyer who has the expertise to come in and say, hey, I can scale this quite quickly if I just put my marketing team and plug them in, and they have the ability to scale this at low cost. Or, hey, they're using a 3PL that's costing them a fortune, or they're renting a warehouse that's costing them a fortune. I'll just plug them into my warehouse that I've already got, and we've, profit margins increase there as well. So the business, it's about knowing the strengths and weaknesses of your businesses, or gaps is probably a better word, so that we can then use them to find the most suitable buyer, because they're going to come up, as we have mentioned in the due diligence. All right, everyone wants to talk about valuations.
That's right. That's where the money's at.
Most, yeah, I want to know if I can get the millions and millions of dollars. So how much is your business worth, and how do we, do the valuations essentially? So when looking at a business has different types of assets. So they have your tangible ones that will literally have, you can see them or you can read them. So your financial performance. So that tells us the business is growing, it's not, what it's making. That's something we can grab a hold of, as well as your traffic performance. Things like, do you already have a team that can run the business? Do you have IP, and do you own that IP? So I think that's really important. Sometimes people outsource the IP or the code to get made for like a SaaS or a service or something. If you're going to do that, again, make sure you own that IP. You've got contracts or something stating you own that, just to decrease that risk. And then the intangible assets. So the tangible ones, we can kind of put a number on, a multiple on. The intangible ones are a little bit, we're less able to do that. And that's things like goodwill, scalability. I would put almost like gaps in there as well that I spoke about before, where, some buyer is going to see one business and they're going to value it at a very high multiple because they can actually, see the value of it. They can see how it strategically fits into their business. Another buyer is going to look at it and say, Fiona, how on earth did you come up with this valuation? I do not see anyone paying that amount. So it's in the eyes of the beholder. It's in the market is going to, reflect back what buyers are seeing and what they're willing to pay. But this is essentially how we kind of come to a valuation.
I think that one is really important. That the value is in the eyes of the beholder. But when you're doing a business transaction like this, so for example, I mean, we had one group who they were acquired because they were monetizing what they're doing really well. So the acquiring group had a lot of traffic, but then the smaller group had a great model that they could scale out. So even though, as you said, what their gap was perhaps they weren't able to scale to that level of traffic, but they had a great
Mm-hmm.
model that could easily be replicated, and it's actually been done now once they were successfully acquired. So again, understanding the buyer and really breaking that down. There's my understanding is there's no one type of buyer, right? There's many different reasons someone
No.
would buy.
Mm-hmm.
They could just be buying it because they want a bit of cash flow. They could be buying it because they want to click it into a larger group or a
Mm-hmm.
series or suite of products or something like this. So yeah, there's many ways, and I believe that's the creative side where it gets quite interesting.
Yeah, I mean that's a fun for me. You know, is finding the people and doing a bit of matchmaking essentially. But that's like the perfect example of a strategic fit. Someone's got something that someone else wants, and so they figure out how to work together and make a deal happen. So that's
Yeah,
ultimately what we want to do. And if you do prepare yourself for an exit, you have that time to find that strategic buyer versus if we have to sell,
yeah,
if we're burnt out, if there's a life, you know, something that comes up in life that makes us have to
crisis.
sell, yeah, then we don't have the luxury of time to find a strategic buyer. So we
Yeah.
may have to consider someone that doesn't value it as high as someone else.
A question I get a lot from startup founders is this whole fear of, oh, but a competitor's going to come in, especially the Googles and Metas of the world, and they're just going to replace my idea. And number one, I have rarely seen that. I know it does happen, but
Yeah,
in hundreds and hundreds of instances, I haven't
yeah.
seen it. What I find more often is that if you do a good job, then you'll be the one to get acquired because the
Mhm.
larger companies don't want to go through all of the heartache and pain for 4 years of building from scratch. So that's the line to aspire to, is get past that, and then you have the ability to exit, and they can leverage what the hard work you've done.
Yeah, absolutely. And for them, it's quite expensive to build, right? Rather than buy, because they're a lot of the founders that I work with, and you probably work with, they're bootstrapped it or they've done it quite lean and, they've done it themselves. Your Googles are paying very high salary engineers, or they're paying, you know, um, a ton of people on a team to do what this founder has already done. So what they could buy for 5 million is going to cost them, 20 million. So
Absolutely. Yeah.
it, it makes more sense for them to buy more often than not.
Yeah. Let alone the failures, as in they could hire someone and then they didn't do a good job for
Hmm.
2 years and they close that project. So it's important for startups to really know what position they're in. It can be hard, right? Because you're on the ground, you may, have little revenue compared to what you want and all of
Hmm.
these things. But the more you get a 360-degree view, we call it authentic awareness, right? Knowing what's going
Hmm.
on, then you're in a better position to negotiate, know your options. Yeah,
100%.
very good.
Yeah, and that perfect, I guess, segue into this is like the other thing to consider when valuing your business, and this goes into how urgent is the exit. We kind of talked about what deal structure are you open to, and what's next for your business. So these things are very much we need to consider in the valuation, because if it's urgent, we need to value it a little bit less to kind of push that time. And then deal structures that you're open to. So if you're coming to me in this market at the moment and you said, Fiona, I'm only accepting cash and I want, 4x, I will say, okay, that's we're gonna be here for a while. We're gonna have to do quite a bit of work to get that. If you're being flexible and saying, well, I'm I had one example last week actually. They've got a really successful SaaS business based out of Australia. They are have hit a point where they're like, we don't want to wear the CEO hat, but we're happy to stay on. We're happy to work for someone else who will help grow our company, the company they built. And we're open to earn-outs, seller financing, as long as there's a certain amount of cash portion up front, which we discussed. And we're flexible on that. So we are able to value their business higher because they're willing to kind of wait for that payout. But so you've kind of got to look at, hey, how much do I want up front? You know, how soon do I want to be out of it? Or am I open to riding the wave a little bit, putting my trust in a buyer and getting something on the tail end?
So for those who may be new to this, it turns into this type of myth that transacting a business is like buying a pair of shoes or something, that you just go, you negotiate the price and you walk away. Like a large number of them, you're in there and you're transitioning, and you know, because the business is a live organism, there's all of these pieces, even handing over relationships and things like that, it all needs to happen. So things don't have to be exactly, as you mentioned, perfect and everything neat, as if, like, you know, everything's like that. It can benefit, definitely. Like, you don't want to have it so chaotic, like that's another end of the spectrum. But you know, there's a bit of leeway that I'm hearing of what you're saying that then can be padded into the deal.
Yeah, I mean, M&A is not black and white. Like, I have people come to me all the time and say, what happens in this situation? What happens in that situation? Or what do we do here? And we literally just have to use best practices. My experience, I've got, you know, the experience to help move it and pull levers where it needs to be pulled. But I don't have a glass ball and say it's exactly going to go like this. There's no black and white. We kind of mold a deal so that it fits right for the buyer and the seller. That's the beauty of it. It's figuring out what will strategically fit for both and making that happen. And I think it's really important when you're looking at deal structures to look at it from the buyer's perspective. So why are they proposing an earn-out? Is it because they, you know, you might go as a seller, you might go, it's to take advantage? No, it's because my business actually is really high risk, you know, that the Google updates might come around again and it
there's
pulls
nothing there, or
revenue.
it drops.
Or, you know, I've asked a really high multiple and, you know, they're happy to pay me out as long as they're kind of seeing the growth. So things like that. And then the last point is just what's next for your business. Like, is your business scalable, which I alluded to before, but, you know, where is your business going from an industry perspective? Is it going to be extinct in 5 years' time? Or is it, you know, is it pretty forward moving and involved in AI or adopting practices that are going to be really big in the future? And of course, none of us know that, but we can kind of see the writing on the wall a little bit of, you know, is an industry or is a business going to be around in 5 years' time, or is it just not?
Very good. Yeah. One thing that I just thought that some of the listeners may be asking, so we were talking about the valuation. So what's the range of multiples you're seeing in today's market, Fiona? What should people high level expect?
Yeah, so we've got a really good live comparison tool, which I can link in you to and your community to. But it really depends on the business type of business. So like your e-coms, a really good e-com is going for 2.5 to 3.5 adjusted net profit, so EBITDA. And when I say EBITDA, for those that don't know, it is your gross revenue minus your operating costs. So it doesn't include the car that you might put in there, or the travel and stuff like that. It's exactly what's operating at what the expenses are to make your business operate. And then if we're looking at SaaS apps, they're going to hold their value a lot more, particularly, you know, at the moment in the B2B space, just with the geopolitical movement at the moment and where the market is. the recurring revenue, the evergreen industries, and the reliance that businesses have on these softwares is what buyers are really looking for. So they're going to hold, multiples closer to that 4 to 5 x, and we typically do value SaaS on revenue.
Yeah, very good.
Yeah,
awesome.
Yeah, and I mean, we could go into so many. You can dive even further into all these categories.
There's a lot of nuances, so. Right? Yeah, exactly.
Yeah. Cool. So, as far as who are the buyers, so on Flipper, this is a few of our stats. So, we get about 20,000 new buyers monthly. Obviously, they're not all going to be relevant to your business. We have very small businesses. We have very large businesses on Flipper. So, but there is going to be someone in there that is going to be interested. So, and our buyers, they do have businesses. They do have a pretty significant budget, and they really fall into 3 different categories. So the first one's going to be like a side hustler, maybe someone that's looking to buy something to then take over their full-time role. They're going to be looking for, the smaller stuff, probably up until about $500,000. And then about $500,000 and above, you've got your private equity, family offices, high net worth individuals who have portfolios, investing in, maybe they invest in multiple different industries or type of assets, maybe real estate, things like that. And then they also do in digital as well. So then we also have strategic buyers. So they're going to be people that will come to us looking for something quite specific. And I've got a case study of one of these in a few slides. It will be quite specific because they've got that gap in their business and they're looking to buy versus build, as was mentioned a couple of times. So, they're really the 3 typical types of buyers that we see.
Awesome. So there's definitely a range there. And again, like we've been repeating this thing, understanding your buyer, but then this is not just a buyer. There are multiple different buyers with all of these different, rationales behind what they're doing. I think like those groups are really important in terms of, are you selling, for example, up to $500,000, around a couple million or to higher? And then if you can understand the rationale, then it makes it better for you to be able to position yourself for something that would make sense.
Yeah. And when you're selling a business, like I will come to you and I'll be talking to you about buyers, probably from 2 out of 3 of those, maybe even all 3 of those categories. And we can use it to prioritize a little bit as well, because some buyers are going to have access to cash a lot more quickly than others, or some are more experienced in the process of acquiring businesses than others. So it's not to say we wouldn't sell to someone that has never acquired before, or maybe needs to get lending from a bank or something like that. But if we're looking at buyers side by side, you kind of look and say, well, what's the risk on as a seller? What's the risk of something not going through, and where can we mitigate that with the risk of the deal as well?
Okay. Yeah, got it.
That's just a quick statistic. 6,000 plus family offices and institutional and strategic buyers. So we are worldwide. A lot of these buyers also will buy globally as well. So just because they're based somewhere doesn't mean that they will only buy there. Cool. So I've got some common mistakes to avoid, and this is kind of throughout just thinking about exiting as well as doing the exit itself, before jumping into some case studies. So I think ones that I've seen is like you mentioned before, when you're selling a business, you're still going to be running the business at the same, or if not even more aggressively than you have been, because if you take a step back, then the business is most likely going to see a decline, and then that valuation is fluid. So if it takes 6 months to sell a business, that valuation can stay the same, it can go up, or it can also go down. So if the business grows and we can justify that valuation going up, then we can justify it going up. If the business declines, we cannot justify that valuation where it was when we priced it at a higher performance. So yeah, a common mistake is when someone takes a step back a bit, or they make changes, like quite drastic changes to their business. So maybe they completely change their marketing strategy. They, take different products off. They just do something that is not normal, which can have either effect.
So roughly speaking, you want to stabilize things as much as you possibly can, because they're going to be looking at your track record, your history, and so it's a bit tricky to take a bold leap right when you're selling.
Yeah, because they're going to go, why did you do that, and what's going on, and what risk? It's always going to come back to risk. So what risk is that going to be? Poor reporting, it will be an absolute headache if you do not have a handle on your financials, your traffic, your understanding of your business. So you will need, like, buyers will not buy without reviewing all the information they need. So if you have poor reporting, it's either going to take a really long time in the middle of the process to get it together, or and be quite stressful, or the buyers are just going to walk away. So having that from day one is going to be more beneficial. Disqualifying buyers too quickly, when someone comes to me and says, I do not want to sell to a private equity, they'll rip it apart and they'll hurt my baby. That's not always the case. There's different types of buyers in every different category. So it's about keeping an open mind, meeting these people, working with me to decide, are they the right buyer or not? Being inflexible with terms, pricing, things like that. If you're too stuck, if you're not going to listen to the market, listen to the buyers, listen to your advisor, whether that's me or not, you're going to find it a very, very hard and uncomfortable process. Not using escrow service, whether it's like we have our own escrow services at Flipper, whether it's lawyers that can act as an escrow service, whatever it is, that's one of my number one pieces of advice, to always use that. Just protect the money, whether you're a buyer or whether you're a seller. And then not consulting a professional. Doesn't need to be me, doesn't need to be Flipper. That's not what I'm saying. It's just doing this on your own is going to be extremely hard.
And I think this is the one that, like, as we were discussing this, the things that were coming to mind for me were these. So again, we at Engenesis Ventures, as a technology venture builder, we're working far earlier than this process, right? And especially the technology, right? So the technology is one of the big factors if you're going to sell a technology business. And there was one group, I mentioned them, they came in, they had the one CTO, it's more like a one-man band CTO, right? He was sitting there doing everything. We brought in the team, brought in like 6 to 8 engineers, refactored the whole thing, and about 12 months later, that then went through due diligence with like a $40 million group, and then they looked back at it and went, oh man, this is structured very well. In fact, they said some parts are structured better than their larger software, right? So that's sort of a positive story of what you may want to be in to exit. But we've had the complete opposite, where people, we were talking to them, they went through the whole journey, and then in their due diligence, they open the hood, and then they find that there are all of these band-aids and things have been done in a spaghetti way, and then it just can stop the whole deal, because that's not an asset. It's just like someone's pet project, right? So I think that this is one of the biggest things that on our side as a tech venture builder, we go, hey, let's look at what does it take. Now, you don't have to do it all at once. You can plan that at certain levels of your business growing, but you need to be mindful of things like technology debt. Like, where are you building something for the short term that has to be changed and restructured for something of high growth? And yeah, like how are you building this in a scalable way so that it can be acquired more easily? You could even click in, so that software, that particular one that I'm thinking, got acquired into the larger group, and then they ended up integrating it all, and it fit nicely. It ticked off all of the boxes before they then completed the acquisition.
Yeah, 100%. And that is, I mean, some people start some of the most successful ventures just as a side project, or just kind of figuring some stuff out, and maybe it's not the most sophisticated technology to start off with, or maybe they started it 10 years ago and it hasn't been updated and things like that. So I think it's about getting it up to scratch, and asking for help there, and getting advice and professionals to help you, so that you're in a better position, for sure.
Yeah. I think what I'm getting from all of this is it's a bit of that where and when, but then anticipating that. So, you might not need that in the first 3 months of your venture, but as you build and as you get to revenue, then really knowing your options that, okay, we need our sales and marketing to be systemized at a certain level here.
Yeah.
We need the technology to be at this state. We need our documentation, our reporting, as you mentioned. I love that, because that's a huge one that gets missed, is that people are doing a lot of things, but they're just not tracking it. And it comes up and bites them later on. So yeah, so I think for everyone listening in, it's like this being part of your plan, knowing that you have those options, and being as informed as possible. Yeah.
Yeah, for sure. It's just going to save you in the long run, and I know it's not everyone's forte, but the admin of it and stuff, but it does help. So yeah, a couple of success stories. So this is a marketplace that was sold, B2B marketplace, that connects models of photographers and influencers to brands. It's Australian based and was bought by a buyer out of Hong Kong. So you can kind of see a few of the metrics there. The tech was really good tech in this one. So it did go for a very high multiple. Marketplaces are valued a little bit differently. They're kind of their own separate beast. So you will see it's a 22x adjusted net profit. I believe it was something like a 3x revenue. So they are just valued a little bit differently, because they have that repeat customer rate, and to acquire a customer is quite sophisticated. So, and you can see there the excellent repeat and utilization rate of 65%. So, but looking here, I find this one interesting. So over almost 4,000 buyers were matched, and 32 people were qualified by me. So that, when I say qualified, is I have a conversation with them and figure out who they are. Do they have the funds? Because this was a 7-figure business that was sold. How they would get the funds, what their capability was to even take this over. And yeah, really, successful. The buyer was actually, he saw the platform and said, I, in my business, have trouble finding influencers and models and that sort of thing. So I can see the need for this type of platform. And so he saw the value.
Yeah, so that would solve the problem right away, to have a whole network and marketplace there. But while that's actually bringing in income and something that's no longer a cost, it actually makes the money.
Yeah. So
great.
that was that was an interesting one. This was a really big one out of Singapore. So this deal was sold for 8 figures, 36 mobile apps in a portfolio. So based out of Singapore, the business, and sold to an app aggregator in Boston in the US. So again, there's that cross-border transaction that we work with, and really not sure they would have even come across each other had they not met on a global platform like ours. So 5.4x adjusted net profit. This deal, I believe, took about 12 months. So 8-figure deal, that's what, you're going to expect it 12 months long. And then this one is one that this was really interesting. So this is a very strategic buyer, and it's one I mentioned a little bit earlier that I was going to bring up. So Daytrace Spy is a education platform for trading day trade, sorry. And the Eagle Publishing that bought this business, they were actually internally talking about establishing this a business that did this in their media company. And Daytrace Spy was about 19 years old, I think. So huge community, huge branding, that sort of stuff. The owner was the face of the brand, so that was a challenge that we had. He was plastered all over it. The people came to get his expertise, but he stayed on and now works with Eagle Publishing, and they essentially have grown the business. He had an earn-out structure that got him a 4.6 adjusted net profit multiple, which was quite high for the business with all the risk that they were taking on. So yeah.
Okay, so this is one where they would have created those materials themselves, and they could have gone through a multiple-year journey, hired all of this stuff, but they went, oh, this person has it already mapped out, and then let's actually integrate that in, and then it becomes sort of a channel for themselves.
Yeah, and then if you think of things like, you've not only got to build it, you've got to get the customers, and the cost to acquire customers is quite expensive. So, to be able to acquire a business and have the owner stay with you, super valuable. Obviously, he had metrics he needed to hit in order to get the full valuation, but he successfully did that. And both parties have been super happy with that.
Awesome.
And then last one, so this one, different buyer, so not strategic, just high net worth individual buyer who had experience with SaaS businesses. So he saw Upgrade Chat, which is a payment processor, and was able to get investors to help him and his own funds essentially acquire it and scale, because he has the knowledge and ability to scale SaaS businesses. So nothing overly strategic from that one. Just the individual knows the businesses, can do it. That's now his consumes him now. That's his day to day.
Yeah, very good. I'm saying that all of the active inquiries are all, hovering at that position where that, how can you say, that's more than enough to then complete the deal. So really that's what Flipper takes care of, rather than sitting and reaching out to hundreds of prospects and then trying to filter it down like that. That's the main thing. Is that right? That saves a lot of time.
Yeah, I mean, of course, if you're running this was also a 7-figure sale. So if you're running a 7-figure business full time, you're trying to scale it, you're trying to keep it going, and then you have to reach out to over 8,000 companies, buyers, and then 202 of those get back to you, and you have to then qualify them, and then say, meet with 20 of them, and then say negotiate with 10 of them to finally get to 1 or 2 that we get to due diligence, and then that one to close. Like,
There's a lot of
By all
work.
means, you can do it on yourself, but
You can DIY,
you're gonna
but
be
yeah, it's like building your house on your own type of thing. Yeah.
yeah. So, it's worth it in my opinion. But of course, I'm the broker, so I'm gonna say that. Yeah, and then just what's next? I mean, a couple more things about Flipper. So you've got me there. If I'm always happy to jump on calls, answer questions. You do not have to be selling in the next 6 months or anything like that. I'm just happy to help. Check out Flipper. You can go window shopping. It's really fun. We've got live data insights and success stories and blogs posts as well.
Yeah, I think the great thing about Flipper is you can see the other ones on there, that like what they're selling for, what they're asking for, so you can gain that understanding of this is where I may fit into the market. These are examples of things already done, depending on what's disclosed in that. But then it then sharpens, where and when you may choose to exit, if that makes sense for you. Very cool.
Yeah.
For those of you who are on the call who are a bit pre that stage and you're a startup, you're going, okay, we're not going to exit now, but we want to build up the value. So that's why we are on this call. Fiona and I were talking, going, this can be a really great way to partner for startups who are in the early stage. They may want to choose an exit at some point, or they may want to, ride the hypergrowth sort of pathway. But either way, by sitting and talking to our team, we can sort of judge that. Either on the recording, we'll put that in the button below. If you're here live, I'll just put that in the chat. So yeah, feel free to chat to Fiona or myself and our team. So in the end of the day, like supporting founders to win, to build their business, build their valuation, that's what it's all about. That's why you're putting in the hard yards. But what I love about this statistically is, you guys at Flipper work with where most of the activity are happening, right? So, the ones like going, how can you say? So there are so many more startups who are going to get to these significant levels and have a life-changing payout, right? That is going to be worth all of their blood, sweat, and tears. And so, yeah, really understanding that these are your options. And so I would say plan it in your horizon. So this is what we like to do, is getting teams to plan that if we get to here, we have the potential to exit. Do we take it? Well, that's up to you. Yeah, that's now an option, but it's not it's not just something that you thought of last moment. Yeah, very cool.
Yeah, absolutely. And I mean, there's so many, everyone that starts a business and works with you guys and gets to a point where they can exit should be super proud of that. It's not something that's easy to do. So yeah, we're just happy to hear from people and happy to work with you guys that are helping people achieve that.
Absolutely. So there's a couple questions. Well, one in particular. So George said, what assets would be placed into escrow?
So the assets are not placed into escrow, the funds are. Escrow holds the funds, and then the assets do get transferred across, either depending if it can go straight to the buyer, who will then you can see the funds release, the funds sitting in escrow, and they can be released either by the buyer or by us or by escrow. Or if you have concerns around that, you can actually send them to the lawyer, and the lawyer will, they absolutely legally have to release the funds when they've received them. They can be disbarred for not doing that. So you've got a couple of options there.
Yeah. And is that normally, is there a sort of deposit and then you go through the last steps, or is that the escrow for the whole amount?
Typically the escrow for the whole amount, or assuming there's no earn out or anything, it's for the first closing payment. Yeah.
Got it. Very cool.
Yeah.
Awesome, Fiona. So look, on behalf of the Engenesis community, we'd just like to thank you. I mean, again, there's so many valuable pieces in there, guys, that if you're in the early stage of your startup, maybe you're revenue generating, knowing that these options you have available, they give you power, they give you leverage, right? I mean, there's nothing like, how can you say, you're there just with a blank sheet of paper building this thing. if you know that you have these real feasible points of exits that can make sense, and I find that it really makes a big deal in terms of then the choices you're going to make, as you then keep building that. So yeah, outside of that, is there any final things that you want to share with everyone listening in, Fiona?
No, just thank you for being here. I appreciate it. I love chatting about this stuff, so always happy to have a chat if anyone has any more questions.
Absolutely. Okay, so we look forward to speaking more about this. Take care, everyone. We'll see you next time.
Thanks. Bye.